Welcome to Joe's Happy Hour, a show about markets and life hosted by Joe Fahmy. This podcast is for informational and entertainment purposes only and should not be regarded as personalized investment advice or relied upon for any investment decisions. Joe Fahmy is an employee of Zor Capital, and he and his clients may maintain positions in the securities discussed in this podcast. All opinions expressed by Joe are solely his own and do not reflect the opinions of Zor Capital. The views expressed by guests are their own, and their appearance on this program does not imply an endorsement of them or any entity they represent. Thank you and enjoy the show.
Lindsey Bell, thanks for joining me.
Thanks for having me, Joe.
I appreciate you being here.
I'm so excited to be here with you.
I know. I'm excited to have our conversation. Chief Market Strategist at Clearnomics.
Yeah.
I've seen you on many financial networks, publications, and so forth. If you don't mind, can you tell the audience a little bit about yourself, your background, and so forth?
Yeah, well, I'll start with Clearnomics because that's brand new. It's a new gig for me.
Okay.
I just started a week ago, so it's very exciting. And what Clearnomics is we're a platform that provides economic and market insights for the wealth management and asset management industry. And to me, the reason I joined the company is because I believe they're a true game changer for the industry. It really puts the insights at the fingertips of the financial advisors or the asset managers, the insights that they need. It saves them time. They're totally customizable, and we're working on making it so simple and easy for them. So
I'm fascinated.
That's my 5-second pitch.
No, it's not even a pitch. I'm actually fascinated as a financial advisor. Explain a little bit more. Like it's tech for advisors, or?
In a way. So it's tech-driven. We've been around since 2017. We're super fast-growing. We serve thousands of advisors right now. And basically, it puts all your favorite charts and insights that go with them in one place, and you can just pull those charts off, quickly make a PowerPoint presentation out of them, and serve them up to your clients. So you save the time from doing the analysis, pulling the data, putting all the charts together, and thinking of what to say. And it's done for you pretty much instantaneously.
That's pretty cool. I've read a lot of your market insight and market pieces and so forth. I'm fascinated with what got you interested in finance and the stock market and macro and all that good stuff.
Yeah, so my career, it's been long and it's been interesting. I've done a bunch of different things. I think my career, it has a broad arc, I guess, if you could say that. So I grew up in Pittsburgh, went to the University of Pittsburgh.
Okay.
I wanted to get into the banking industry. I'm going to start from the beginning.
That's okay. Yeah. We got all the time. There's no risk. That's a beauty of this versus TV is you have a time restriction with a certain A block or B block or whatever.
Oh, totally.
So fire away.
So I wanted to get into banking. I had a cousin that was in investment banking. And so I was sending my resume in the big manila envelopes, like it was back in the day, trying to get attention. And somehow my resume ended up at KeyBank in Cleveland, aced the interview, got a job as an investment banking analyst in the M&A group.
Wow.
Back in 2024, so early days. And so I was in banking for a handful of years. I did that for a year. Then I moved to New York. I said, if I'm doing banking, I'm going to do it where it counts in New York City. So I joined the M&A group at Jefferies, spent a handful of years there before getting a little worn out, working around.
Those are long hours.
Those are really long and unpredictable hours.
Yeah.
So that's when I got into sell-side research, and I transferred to Deutsche Bank, covering the retail space. And that really kind of gave me a sense for the public markets, because while I was doing M&A with some public companies, I was doing with a lot of industrial companies coming from Cleveland, right? And so a lot of them were mid-market, and so not all of them were public. But so getting into sell-side research really threw me into the mix of the stock market, and I really got my feet wet there. So I did that at Deutsche Bank, did it at JP Morgan before I got the opportunity to work with Jim Cramer at TheStreet.com.
Okay.
And so I joined The Street on his team for his charitable trust. I don't know if you know this. And so I was there when Stephanie Link was there. She was his right-hand person for the large cap portfolio. So I helped him manage a small and mid cap portfolios.
Okay.
And while there, this is how I started doing video. I got chosen or selected or drew the lucky short straw, I don't know, to interview both Jim and Stephanie on camera. And it was, I say to this day, still one of the most nerve-wracking things I ever had.
I was going to say, were you nervous?
Yeah, I was super nervous because I was like in my early 20s too. And I'm like, Jim Cramer, like I'm going to come up with smart questions to ask this guy.
It's intimidating.
Right? It was intimidating. Even Stephanie Link too. So I learned a lot on that job and it was really fun. The difference there was, so I went from investment banking and sell-side research, dealing with institutional clients or corporate clients, to dealing with retailer investors at thestreet.com. Jim's whole mantra there was really to educate retail investors about how to invest intelligently in the stock market, to pull the curtain open. And he still has his investment club through CNBC now, I think. And it was really just showing those retail investors when we were buying a stock, when we were selling it, how to do it, what prices to look for. And so it was like giving them the inside look. So it was really fun and really cool. But I ended up getting laid off from that job, which was like a shocker, right? You know, I was in my, I think, late 20s by then. And it was, you know, it feels very personal. And this was before like getting let go or laid off. I feel like today, in today's society, it's like the norm.
Yeah,
you know, we've all lived through the financial crisis.
Turnover in a lot of jobs, yeah.
Exactly. And so, anyway, so I took a year at that point to figure out what do I want to do next with my career, and I also traveled the world, which was awesome. But
I want to hear about that, but we'll get back to that in a minute. Yeah.
So I decided what I really liked about working with Jim and Stephanie was the macro picture, the 15,000, 30,000 foot view that we took to then drill down into the to find individual securities to fit into the portfolios. And so I loved that higher level where we started from. And so that's when I was like, I want to get into investment strategy. And so I joined S&P Global because I had become friends with Sam Stovall, because I also would interview him at the street.
Yeah.
And so he hired me into the team, and I became an investment strategist there. I was there for a handful of years. CFRA Research, a small independent research shop, bought us from S&P, the whole equity research division from S&P Global. So I was there. And then I got the call to join Ally to be their first ever chief investment strategist.
Nice.
Yeah. And so I took that role on in 2019 before the pandemic was hitting. And I was doing the travel back and forth between Charlotte, where the executive team sat, and New York, where I lived. And then just really decided to move. I told you the story. My husband's a little Zillow expert, and he's always checking out real estate. He's been doing it for as long as I've known him, if not longer. And he tricked me. He came down to visit me in Charlotte once. He tricked me, and so we saw a couple houses. It ended up being a whole day. We fell in love with this one house, and the rest is history. We moved to Charlotte, which has been really, really great. We love the area. There's a lot of New Yorkers or Northerners that have moved down since. The housing market there, we could talk about that, has been absolutely crazy. People buy multi-million-dollar houses to tear them down and build new ones, and it's still happening, even as
still.
Still not as rapidly or
but
quickly,
it still exists.
Exists.
Wow.
Which is wild. And so we actually bought, and we closed the day after the market topped in February of 2020. And I was like, great, we just bought at the top of the market. It ended up being a perfect time to buy. We had a refi, but it was the perfect time to buy because then, as you know, housing prices.
It dropped for 3 weeks and then doubled.
Right.
Or 50%.
Exactly.
Depending on what part of the country,
Yeah. So I ended up leaving Ally in early 2023. And I took some time off, and I've dabbled in a couple entrepreneurial endeavors. I ended up writing a blog because I had been so interested in the changing dynamics in the labor market.
Okay.
And I just decided I was so curious about it, I needed to explore that. And so I started this blog. I wrote it for a whole year. I ended up doing a TED Talk off the back of it.
We're going to get into that too.
Yes. And so it's been just been a really cool addition to the way I look at the market. So when the opportunity for Clearnomics came up recently, it really was a no-brainer for me to be able to marry my stock analysis, market analysis, I guess I should, and macro analysis with the labor market. So
it's a lot there. That is a lot. That's a lot. I have like 100 things running through my mind. First thing on the M&A stuff, was it, did you mention you were working on certain sectors, or was it private? Was it public companies? I'm fascinated by like investment banking.
Yeah, so I was really young. It was a really cool opportunity because at that time, the M&A market was hot. It was on fire. And so I was given so much responsibility at a very young age. I mean, I was calling like CFOs directly, setting up their due diligence sites and meeting with them with like the managing director at the time. You know, we'd go in and sit at a table like this and meet with the team.
Yeah.
But because I started at KeyBank in Cleveland, there was a lot of industrial companies that we would work with, and a lot of them were the sweet spot for KeyBank was the mid-market, and so some of them were public, some of them were not. We would also do valuation appraisals for M&A deals that were already in the market. We'd get hired to approve the valuations.
Okay.
And so those would be public companies. But then when I moved to Jeffries in New York, there were a lot more public company deals. And like as a 20-year-old, I'm like, oh my God, what if I get the valuation wrong on this? Like as if I was moving a market or something, or that I didn't have people, like 10 people above me looking over it. But that's kind of part of what led me to the realization later on that something had changed in the workforce, in the workplace, because when I started my career again, it was 2024 or 2004, 20 years ago.
Yeah.
You know, in investment banking, it was very much a pyramid. Any team you were on, you had your managing director, you had your VP, you might have one or two associates, and you had 2 or 3 analysts on every single team. And then as the years went on, that dwindled and dwindled and dwindled. And by the time when I was at S&P, Sam and I would work together on some things, but we also kind of had our own responsibilities and different things. And I used to say, people would ask, how many people do you have on your team? And I'm like, you're looking at the team. I am the team. But yeah, so it just was an evolution over time. But investment banking, I think, provided a really strong foundation for the analytical work that I would then do in the public markets. And so it was, invaluable. I mean, I'm not as good at Excel as I was back then, but I still get around okay.
Okay, so I said we would talk about a few things later, but before I forget, because I forget what I had for dinner last night, so I need to keep up with everything. You did a TED Talk, how to take ownership of your career. That's fascinating. How did that all come about? And tell us a little bit about that talk, because I watched it online. It's very impressive.
Well, thank you. Yeah, no, it was really fun to do. It just like came to me one day in the process of writing this blog. I was just like, I want to do a TED Talk on this topic because it kind of aligns with what TED is all about. Really, they like bigger picture ideas. And so I just went for it. I mean, there's this quote by someone famous that says you could just do things, which is true. You could just do things. You just have to.
Is that Nike?
Just do it. Just do it. Maybe that's what.
Maybe that's what it was.
But it's just you could figure anything out, right? And so I went, on the internet and tried to figure it out, and was like looking at all the different places that you could do a TEDx talk and how to apply. And it's not the most straightforward process. You gotta like use a little bit of LinkedIn Ninja to like connect to people, and you just kind of weasel your way in is like what I like to say I did. So I did it in Myrtle Beach, which is close to, I live in Charlotte. So I tell you to look in your regional area.
How often do they run them? Do you know?
So they're constantly going in all different parts of the world, actually. So,
okay.
So you have more opportunity to do a TED Talk than you think you do.
Wow.
Not that they let everybody in. It does have to be a big picture idea. But there's the main TED stage that only happens once a year.
That's in Silicon Valley?
Well, it changes locations. Last year, I think it was in Canada.
Oh, so that's the main one.
Mm-hmm.
But still, I don't.
And the main one has become like really like famous people and celebrities driven in recent years. So, I probably don't really stand a shot.
So you ninja'd your way into this, which is impressive alone. And I do believe in that. If you are resourceful enough and you are, you bust your ass and you figure out ways, you can do anything. You can do anything, right? Someone famous said that. We don't know who, but we'll just give you the credit to that quote. So how did you decide the topic?
So I was writing this blog, and the workforce changes is a really complex thing. There's a lot of different moving parts. I think I already said that the pandemic really gets the kind of the credit for the future of work phrase that has been thrown all around. I think it started after the great financial crisis, given a lot of the technological changes and different changes that were happening. But so I really wanted people to feel that, to really get a better understanding of the dynamics that were changing and why they were changing. Part of it is that corporations are changing. We've had in the last year, in 2024, the highest level of CEO turnover on record.
Oh, really?
Yes.
I did not know that.
Yes, it's very elevated. If you talk the World Economic Forum, at Davos every year, they do a whole study on workforce changes. And a vast majority of CEOs said they expect in 2024 that their whole business models are going to change within 1 year. So corporations are changing. Then you've got people changing, right? We've heard the story about purpose over and over again and fulfillment. Whether you buy into that or not, the way people work is changing, how and when they work. They want work to fit into their life, not their life to be all about or only about work.
Clearly affected by COVID.
Clearly affected by COVID. And, I'm actually working on penning a piece right now where I talk about there's this unique connection now between purpose and individuality, which is an odd connection because purpose usually comes from community, right? It usually comes from, purpose, people, religions, and right? Religions and sports teams and things like that. People find purpose in those things. People found purpose in work because you were working towards a goal together with your colleagues. But now there's just been a lot of things that have caused people to really kind of revert back to finding purpose themselves with regards to their work, at least. And then the third thing is just the way we do work is changing. The amount of time that we spend in apps or on videos has increased substantially versus being in person, regardless of the return to office mandates that have been going down, right? And then the fourth thing that I would add, I didn't talk about it in my TED Talk, but I think the greatest driver of all this is economic change. Inflation over the last 5 years is really forcing individuals to rethink the way that they make income or earn income.
Yeah.
And it's also forced them to think about finding other sources of income or stacking income. And so I think all these things are lining up to create a place where you can really create your own career if you really want to. That being said, people do prefer W-2 over 1099 all day long, right? But there are trends in the independent workforce and the numbers are just staggering. So I think it's a trend that is here to stay, and how it evolves is going to be really interesting to see over time.
I love the talk. I thought it was great. And I think everyone should check it out. It's called How to Take Ownership of Your Career. So everyone should check that out. I'll put a link to it as well or tweet it out. Let's talk markets.
Yeah.
Yeah, why not? You sent me a great piece on one of your recent weekly macro pieces.
Yeah.
We just had back-to-back 23, 25, call it 20+% years, depending on what index you want to use, but call the S&P. So back-to-back years coming out of the 2022 bear market, back-to-back strong years. Mm-hmm. Some people are expecting another monster year. Some are saying, hey, we got to digest a little bit. So tell me a little bit about what you're thinking.
Yeah, I mean, it's good to have a divergence of opinions, right?
Of course.
for a change. In this past weekly, what we really looked at was the leadership in the market by technology. And I think when you have 2 years of a bull market, especially above 20%, the statistics show that the bull market's going to most likely continue on for a lot longer. But the third year can be a little tricky. There's no guarantees that you're going to get another. There's no guarantees in the world, right?
And it also depends on what index you use and how far back you go. Because some people say, well, it's based on heavily weighted towards the 95 to 99 range because there's multiple back-to-back. Then some people say, well, if you look at 1904 in the Dow, and there's people. Anyway, so some of the Dow statistics are a little bit off, but some of the S&P are a little bit better. So it just depends on, I don't know. We don't have enough sample size, though.
Right.
There's not, but anyways, I didn't mean to interrupt.
We can all manipulate the data to tell the story that we want it to say.
Exactly.
Right?
Exactly.
But I mean, the fact of the matter is, though, that tech has driven the markets for the last 2 years, at least. And I think people get worried about. We've seen recently that the Magnificent Seven and the tech sector overall has underperformed the market.
Yeah.
And that makes people nervous just because there's this heavy concentration risk. Like the tech sector is more than 31% of the S&P 500, which is a market cap weighted index. I think the Magnificent Seven is something like 30% of the market if you look at it like that. And it's up substantially in the last 15 years. And so the question becomes, is that a problem, right? So everybody likes to draw the parallel to the dot-com bubble when tech gained all this concentration and the profitability wasn't there to support that concentration from a market cap perspective. And that's, some people would argue today that that could be a similar argument because I think there's only 22% contribution from the tech sector to the overall S&P 500, so that 22 to 31% spread is a lot wider than history. I mean, theoretically, they should be pretty closely aligned, right? And so that does draw a concern.
As far as what they contribute to earnings versus market cap.
Exactly.
Okay.
But what I would say is the market leaders right now, they are dramatically different types of companies than what we had in the dot-com bubble, right? These are companies with significant cash flows, with margins that are very robust.
Huge profit margins
that are continuing to expand. They're also very diverse companies compared to what they were back in the dot-com bubble. And even today, with the foray into AI or other growth markets, and the concern that right now with DeepSeek is the competition, is their competitive moat so strong? What's the competitive landscape really going to look like? What is all this spend going to achieve from a return on investment perspective? Those are real concerns at a time when valuations are still elevated. But again, these are different companies now than what were leading the market in the dot-com bubble. If you look at history, some of the largest companies in the index have historically really been boring companies that just provide stability for the market overall, right? And so there should probably be some reversion to the mean from a concentration perspective. And I think you're kind of seeing that in the rotation that you're seeing into other sectors in early days of 2025. I know we're almost done with February, but you're seeing, sectors like financials and healthcare.
You mentioned materials.
Pick up the slack. And I think that people are talking about that as, looking for better valuations, better opportunities. But I think what people aren't talking about is the rotation within tech that's happening. Sure, tech is down and communication services is up. Communication services is at the top of the pile still, and it's been up there for the last couple years too. Meta's getting all of the credit for this, which bothers me a little bit because if you dig below the surface, which is what I like to do, Netflix is up double digits this year.
No one talks about Netflix.
No one talks about it. We forgot about Netflix.
Yeah.
It's not part of the Mag 7 anymore.
It used to be FANG, and they dropped it.
They dropped it.
It's like it's not part, but it's just knock on wood, just slow and steady.
So Netflix is doing great. Take-Two's having a good year. Match is hanging in there. So some of the entertainment names, but more so than that, looking in below the surface in the tech sector, you're seeing a rotation into companies like Cisco and IBM and Accenture. And so I think it really is this, I don't know if it's a search for GARP. I don't know if you want to call it that, growth at a reasonable price, or if it's, part of it might be looking for second or third derivatives in the AI play. Either way, whatever you want to call it, it's a broadening out of the market, which is a super healthy trend. And in an ideal world, instead of a bubble popping, what we see is the concentration from tech is reduced, or their profitability is increased to match the concentration, while other sectors kind of pick up the slack, right?
Yeah.
That would be an ideal solution. There's no guarantees a bubble pops. There's no guarantees that happens either. Maybe we land somewhere in the middle.
Art Hogan has a great quote that a bubble is an asset class that you don't own. That's a bubble. You only complain it's a bubble because, like, if I own it and it's going up, why would I complain?
That's so true.
It's
right?
the stuff you're not in. If you're not in crypto, crypto's a bubble. Do you own any? No, but no one who owns it will complain. So anyone who's saying that, but anyways, I mean, there's a big difference where .com, not only was it, okay, Yahoo does 3 cents versus 2 cents, or this has this many eyeballs or clicks versus last quarter. Eyeballs and clicks, remember?
Yeah.
This is like, oh no, you did $12.36 versus $9 like per share in earnings. So this is no joke. This is, I don't want to say this time is different. I know those are famous last words, but there is definitely a difference, as you said, with huge earnings power and almost double the profit margins.
Yeah, I think if you look at Amazon, and I might not be spot on with these numbers, but they, the big number that came out is they're going to spend $100 billion on AI investment.
CapEx expense. Yeah.
But they have $100 billion in cash flow too.
Yeah.
So and I don't even know what cash they have on their balance sheet, but
no. I remember asking a famous short seller who never shorted Amazon. And I said, you've never shorted Amazon? He's like, we dug into it. And he said, they've been cash flow positive since 2003. So I wouldn't touch that. So everyone's saying valuation. He's like, they were making tons of money even back then. They were just reinvesting it into their business. So that was smart to pay attention to something like that rather than just a strict PE, like digging into the financials, which I respected because he did not short it because of that. So
well, and it's also, if you think about Amazon as an example of long-term thinking, like long-termism versus managing to the quarter or to the hottest trend or your business model just to fit AI into it or whatever the trend is, the metaverse, like when that was hot. But some of these big companies have the opportunity to make those outsized bets on things that may or may not work. But I don't know. Just the point is long-termism versus short-term.
Oh, yeah. No, it's getting to the point where I think Amazon's just dropping packages off at my house. Like, I don't even order them anymore. I'm just like, oh, there's the Amazon guy. And it's just, I'm like, it's AI. I'm like, I guess I need this. I don't even know anymore. They're just dropping off packages.
Well, the worst is when you get your credit card bill and you're like, Amazon. Because they charge you once it's delivered.
Per shipping, per item that's shipped, yeah.
And I'm just like, I don't know what that is. It's got to be right, though.
Yeah, it's good. Yeah, just throw in another charge. Yeah, we're giving Bezos ideas. If Bezos is ever listening to my podcast, just throw in AI charges that would make sense that we would approve. Yeah. Right. Continue with, you're right, usually even if we do have a couple of good years, the third year, it can continue, but the third year can be a little bit shaky. But we are seeing, I view it as you have a big Thanksgiving meal, you got to lay on the couch and digest. That's how I look at it. You just had some of these stocks. You've just had some of these stocks make big moves and they're just digesting. I actually study price action. It's kind of normal when NVIDIA goes from 3 to 150 and goes sideways it's not that unexpected. But to your point, beneath the surface, I see financials, XLF is the main ETF. And I'm like, it's not just Goldman and JP Morgan that are like the cream of the crop in there, but all the credit card companies, all the 4 major credit cards, all at new highs. Capital One, what's in your wallet, all of that stuff. And then you see materials. So what's the expression, the hallmark of a bull market, sector rotation, whatever that is the hallmark of a bull market. So is that kind of what you're saying in your piece, is that while tech is digesting, which you're finding to be normal, other sectors are carrying the weight of the market or holding it up?
They're holding it up and they're carrying, I don't know if they're carrying the weight of the market, but they're participating. And you're seeing it. It's not just like, okay, this stock is cheap or the sector is cheap, I'm going to buy into it. They have the goods. They've got the receipts, right?
Yeah.
If you look at the last earnings season, which I didn't expect to be very blockbuster because expectations were high going into it, in my opinion. We were looking for almost 9% earnings growth. We're at about 14%. The retailers and some other companies still have to report here fourth quarter earnings. But you know who had some of the best beats? It was industrial companies. The financials were at the top of the list. The industrial companies did really well. They came in much better than expected. Consumer discretionary was better than expected. And so it was some of these sectors that, and communication services also.
Oh, yeah, it's huge. Yeah.
So it was some of these other sectors, and healthcare, I left out healthcare, that are kind of been forgotten about or left behind. Healthcare was left behind. I think that had political implications.
Yeah.
And it's coming back. So I heard someone recently say that the healthcare performance more recently is more of a reversion to the mean. And I don't think so. I think that they have the growth to support the upside in the stocks that are driving it.
Do you think after RFK was, what's the word I'm looking for? Health and Human Services was mentioned as, what's the word? Like, not inducted, but was appointed. Sorry.
Yes.
Appointed. That hurt, especially biotech. But now that he's confirmed, could it be a sell the rumor, buy the news, maybe?
I think it is.
Or maybe the fear of at least its certainty, so we know what to expect. Or I don't.
Yeah, I think it's a little bit of that. I think it's still TBD, and I think we'll see now that he's in the seat how things shape up. I mean, things are moving very rapidly in other parts of the administration, right? And that's impacting markets, but it's adding this volatility to markets that I think creates opportunity for folks like you that are trading.
Yeah.
But it also volatility isn't necessarily something that we should potentially fear. I think that's what also is, creates, it just creates an interesting market, right?
Oh, it's part of the markets. I mean, you're going to have volatility. You're going to have unexpected news.
Yeah.
And if there's always that, I always like the expression, it's not the news, it's the market's reaction to the news. So if you're fearing some CPI number, like that low October of 2022, highest inflation we've seen in that whole cycle. And that marked the bottom because it's not the news, because it's like, okay, the news was horrible, but the market finished at a huge reversal that day. So it's not the news, it's the market's reaction to the news. That's the market being a discounting mechanism. It forecasts what's going to happen 6 to 9 months from now, as you know, and all that. So it's basically forecasting, yeah, that's the worst of inflation at the time. But a lot of people get so caught up. Same thing with a stock. You've seen a stock beat earnings and guide higher and it's lower.
Yeah.
And you're like, well, that's unusual. I've also seen stocks miss and give horrible reports. Why is it green?
Right.
So it's not the news, it's the reaction to the news. And that gives a lot of information to investors and traders.
No, exactly. And I think that's when I'm talking with retail investors, that's something that comes up very frequently. Another thing you might not know about me is that I'm the chairman of the board of a nonprofit called Better Investing, which educates individuals how to invest correctly in the market or individual securities.
Okay.
And so a lot of times we'll get questions from the newbies like, why was exactly what you outlined? Why was that
They had
stock
good earnings,
up?
but why was it down or something like that?
Yeah. And so it's kind of like sometimes there's a reason, sometimes there's not. But the market is in general, efficient at pricing in expectations.
Yeah, I always find it tricky. It's like a lose-lose with talking about individual stocks because if it goes up, when do you sell? And you tell them to sell. If it goes down, I mean, over time, I get, and I'm an active portfolio manager, but I get the case for passive because over time, every 10, 20, 30-year period or whatever, the S&P goes up. But that works if you want to stay passive and chill and just, you're working on other businesses or travel or whatever you do. But with individual stocks, it gets tougher because not every individual stock goes up forever. No. There's some exceptions recently. Apple, Amazon, for example, have done well. Google, like some of the Mag 7 over time. But one, they also had huge corrections in 2022. And two, not all of them come back. And it's very, very difficult because some people think that, oh, this is my stock that I love and it's going up forever. And when you study history, the market does. The index is designed to, with stocks constantly going in and out, taking out the worst and putting in the best. Yeah. But individual stocks don't always do that. That's why I have trouble, even as a trader, when someone's like, give me a stock, I'm like, I don't want to do this because they just think you're going to buy it and it's going to go up forever. And it's a very bad misconception.
It is, and you have to continuously monitor those securities because this isn't like the market of the past where there would be long stretches where specific stocks would do well. Now the market and business cycles and everything moves a lot faster. And so if you are going to own individual securities, you have to continuously review them. So it's not a set it and forget it strategy. And that's where we struggle at Better Investing is you have to commit time to doing this. So it's a...
Yeah. And another point I just thought of is in the past, companies would IPO at a much lower valuation. Mm-hmm. Where the private markets were not as liquid, where if Elon Musk wants to raise $2 billion right now, he'll have it within an hour.
Yeah.
Where people forget, I think of the 90s, Microsoft, Intel, Cisco, and Dell were some of the four power, whatever, the Mag 7 of that time. Yeah. Where Microsoft did the software, Dell was the main PC, and there was others, Compaq and others, of course, did the main PCs. They put the software on it. Intel put the chips. Cisco connected them all together. But those were monster winners of the 90s, but they IPO'd at, some of them 300, 200 million with an M valuations. Yeah. So you had huge, even retail with Walmart and Home Depot in the 80s and 90s were huge winners.
Yep.
But they IPO'd. Now, Facebook IPO'd, people forget, 40, 80 billion, whatever, in the billions with valuations. You have companies that might come public this year
in the billions
that are 30, 40, 50 billion valuation. I mean, SpaceX's last funding was 350 billion.
Yep.
So that is why I think part of the reason in the past you could sock away some in GE and Microsoft and some of these because their valuations were so low, where now you're IPOing and you're kind of priced for perfection when you come to the market later.
Well, and it's a testament to the private markets, right? How big they have gotten, and even individual investors can get involved in the private markets now. I'm not the expert on this.
No, I'm not either. It's just a general conversation. Yeah.
But in general, yeah. So then it brings a lot of these companies to market to IPO at a later stage in their business, in their development than what they would have done, 10, 20, 30 years ago. So it creates a different opportunity.
It's wasn't Instagram they did a round of funding at 30 whatever million, and then someone's I'll give you 100 billion, I'll give you 700, I'll give you a million, whatever. Yeah. It literally went from 30 million to $1 billion valuation in just some bidding in a month.
Oh, I know. Well,
and they had 14 employees.
Right.
it's even not just private companies, but the big companies with huge cash balances, they can make, they have M&A teams within Salesforce, within Microsoft that are looking to make those acquisitions. So.
Constantly looking for what the next opportunity is. Yeah.
Yeah. So it's a great point about the liquidity of the private markets. Yeah. You've made some interesting analogies with 95. If we can talk a little bit about that, or we can continue talking about your piece too. I didn't want to interrupt if there was.
Let's talk about the 90s.
All right.
You've got a neon sign in this bar.
I know.
So
this is a great bar here.
The 90s.
All right. Some people have made the analogy of 95 to 2000 that we're sort of the second, third year of we're still in that early stages with that analogy. I have some thoughts on it, but please go ahead.
Yeah, let's compare notes.
Okay.
So I think that we're probably in that the mid 90s range. I think we've got a ways to go. But if I look at the 90s versus today, there's some similarities, but there are some differences too. And I think the biggest similarities really are interest rates are elevated. They were higher then than they are now. They were in the 5 to 7% range.
Yes.
Inflation was consistently in the 3% range. Productivity was increasing. That's why I think we're in the middle, in the mid 90s, because if you look at productivity, you divide that decade, the 1990 to 2000. The first half productivity was 1.6% on average per year. In the second half, it jumped up to 2.6%. And if you think about now, 2022 was the year that ChatGPT came out. AI really kind of got introduced to layman's, right, to everybody. And I think that it's slowly has ingrained itself into businesses and into consumer environments, and it's still very, very early innings of that. And so when I look at productivity since, I don't know, mid 2022, we're averaging about 2.2%, so just under 2.5%. And I think there's potential for that to increase. I know the latest reading on productivity was a little bit weaker, but I think that there's opportunity given technology advances because of the other similarity is there were worker shortages in the 90s. People were taking on second jobs. The number of multi-job holders reached 6.5% of the working force population.
In the 90s?
In the 90s. What we're seeing today is you saw a sharp drop off of multi-job holders in the pandemic. Nobody was working, right? But there was a sharp rebound. And
I was working as a bartender at home. That's pretty much what I was doing during the pandemic.
It's all coming together now.
It's all coming together. So what is it now?
Now it's like 5.3%, and it's kind of held steady over the last year. But I see potential for that to increase just the way that independent work is evolving, which we can get into if you want. But the point being that there were job opportunities and people that had the ability to take on those extra opportunities did it. When you look at why people did it back then, of course, there was like 40-some% of the people that did it was to gain additional income to maintain their livelihoods. But others did it because they wanted to, because they wanted the extra cash. They were saving up for that big, trip or that big gift for their loved one. I don't know.
Yeah.
So I think that those are some of the similarities, and you saw obviously robust market action in the first half of that decade. The volatility was very low, but it picked up significantly in the second half of that decade. Economic policy uncertainty picked up. It was very elevated, not to the point that we're seeing now and what we saw in the first Trump administration, but it was elevated then. So there was levels of uncertainty. The economic environment chugged along and was strong, but not all was hunky-dory. So those are the similarities I see. I think the difference is the potential for tariffs in an environment where the consumer is becoming increasingly price sensitive. Their ability to absorb higher prices is declining. But then also on the flip side, I do think that the opportunity for workers to have multiplied jobs or to increase income in other ways, unique ways, is a positive. That didn't exist then because of technology, because of challenges to non-compete agreements, because of just the economic environment. So I think there's, pros and cons.
I haven't heard you mention AI as part of that reason. What do you think about that?
Yeah, I think AI is going to be a big driver of productivity, which is why I think that the productivity could exceed 2.5%, maybe even get close to 3%. That's probably pretty optimistic. But
it's Joe's happy hour. We got to be optimistic.
It's Joe's happy hour. I haven't had a beer yet. Give me another one. Maybe say 3.5. No. No, but so I think that there's real opportunity for productivity. I think we're seeing operating margins in the S&P 500, again, reaching 2022 highs in the 16% range, the numbers I look at. And they're expected to get to 17%, which makes me nervous. But if the productivity is
Why does it make you nervous?
Because we haven't been there before. When we got to 16% margins the first time, inflation was averaging, I can't recall off the top. Inflation was very elevated. Sales growth was elevated too because of inflation. It just filtered down a lot more nicely than now when sales are normalizing. I would say they're not slowing significantly. We don't have a massive inflation boost. But I think margins can remain elevated. I just get worried about the continuous expansion. But the flip side to that is if you look at what we do have in earnings, there's probably not a lot baked in for AI productivity in the numbers that we see, even though we're looking at 17% operating margins for 2025.
The reason I was pushing the AI thing is that in our comparing of notes.
Yeah.
My theory is that every big bull market throughout history was driven by an invention that revolutionized our lives. So even going back, I've talked about this before with the railroads. Going from point A to point B, you want to walk from New York to LA, it's going to take you, 3 years? The railroads increased that productivity. And throughout history, television, drug discoveries, airlines, cell phones, PCs, the list is endless, smartphones, I said already. But what all of those inventions have in common, besides revolutionizing our lives, is increasing productivity. So my theory is in the late 90s, the PC revolution and the internet, when I talked about Cisco connecting, so now you have an office in New York and LA, you can talk to each other and connects everyone. So the internet, and even if you had one PC or one laptop, that was a big deal if you had one in your neighborhood. And then now it's some people are throwing them out every year because they're getting a new one or whatever, because it's a commoditized thing.
Yep.
And so the PC and internet revolution, I think, sped things up. And then where I'm leading to, drum roll please, AI, people way smarter than me, the Mark Andreessens and all of these people who've talked about software is eating the world and AI is going to change the world and all this, the piece that he wrote a couple years ago. People way smarter than me have used the expression AI is going to be bigger than the internet. I'm going to be honest, I don't know what that means. I just know that I'm smart enough to know these people are all saying this. You're all smarter than me. So there's, I don't want to be all right, there's something big there. But I'm thinking that is what is part of what's driving productivity. And to your point, can maybe continue to drive that and expand or drive earnings.
No, I agree with you. But the problem is where I get stuck is I don't know what that opportunity actually is. And I think we're still trying to assess it. And I think that's why, like you said, we're taking this digestion within the tech space, because it really is, we're spending, the top 4 companies are spending over $300 billion on AI.
Just this year.
Just this year.
Yeah.
I mean, Meta is doubling what they're spending. We talked about Amazon. And so, the question is does that make sense, given that if DeepSeek was able to produce their AI tools for much cheaper? But so the question is, what does the investment look like? And then what's the return on that? I think there's no question that this is going to help workflow. I think it's big too. And you're already seeing it in just some of the applications you use. If you just use the Microsoft suite, if you just use Google, if you just, even on your text, things are that auto text is
oh yeah, you're you really are a smartphone.
Yeah.
I'm the one who's dumb here. You're predicting what I'm going to say.
Exactly.
This is ridiculous. You know me too well. Yeah, I know.
So I think it's going to be huge too. I just can't quantify it. I don't think many CEOs can quantify it right now. If you can quantify it, there you go. That's a huge business model. You'll make a lot of money.
I'm trying to figure it out too. I know last year Domino's spent $50 million with NVIDIA. And I'm it's for everything, for efficiency of marketing, driver routes, everything. So that's not a tech company. That's a food retail company. But
right.
That's why when they're saying bigger than the internet, I think I've heard other smart people say if you're not involved in AI, you're dead. If you're not implementing it into your business, you're behind the times.
Yeah, or if you're not learning how to use it to help.
Yeah, as a retail, as a personal,
you're.
Yeah, what I love, shout out to my podcast producer Tyus. What I love is that he takes everything and he has these wizards. Speaking of ninja, and does it all through whatever and. In 10 minutes, I can have this whole thing edited and everything through AI, and he kind of, and he, I was going to say,
get rid of the wrinkles.
He can even make me look good, which is amazing. He already look great. He needs to use more AI on me. But no, that's the power of AI. Because I remember when the first time he produced something, I'm like, how many hours? He's like, it used to take hours. It now takes minutes. That's an example of productivity, speeding up the process and saving time. It's really amazing.
Is this why everybody has a podcast now, me included?
Speaking of which, yeah, you do have a podcast. I know we're jumping all over the place. I have ADD, so no, this is fun. This is an enjoyable conversation. So 95, you still think, or 95, sorry, the 90s analogy, to finish your thoughts on that. You feel that this could still be similar, early to mid of, one lesson I've learned in the markets is, one of a million, is just when you think things can't go higher, they usually do, and just when you think they can't go lower, they usually do. Meaning the market moves to extremes, and moves go on longer than we can expect.
Right, exactly.
So
yeah, and I think like the market now gets a bad rap too. We started talking about valuations, elevated valuations, and in the 90s we talked about it. Some specific companies had extremely elevated valuations, and you look at tech right now, it's like double what its historical average was. But again, it gets back to productivity, which is embedding its way into the tech space first and foremost before you get to any of the other industries, right? And you've seen their margins expand significantly, and they've become this concentrated component of the market. So you could argue that the market multiple should be higher than the historical average, depending on what time period you're looking over, right? Do I think that 23 times is right? I don't know. But I think that as long as earnings can keep growing, margin expansion can keep happening, that multiple can probably survive. Do I want to see a 30 times multiple in the S&P 500? No, that's going to scare me.
Yeah,
but,
scare me too.
That's an extreme. And so I think it's something that we got to kind of like keep our eyes on. But I don't know what point I was trying to make here.
No, I don't. I just kind of wanted to wrap up that segment with the 90s talk, because I think there is a lot of analogies that are, I'm noticing a lot of similarities.
If you want to talk about another analogy, another one I was looking at too, in writing this piece, was the 2022 30% drop in the tech sector. And really what drove that, it was really macro influences. It was the speeding, the unprecedented rise in interest rates as the Fed started increasing rates. It was the unprecedented speed of increase in inflation. And so while the tech sector was down 30%, the S&P was down almost 20%, didn't quite get there. But it really was macro driven. And so tech can be the fall guy, right? Because they flew the furthest, and so they could fall the furthest too, right? But if you look at the correlation of the largest stocks in the market, and on the upside and the downside, there's not a lot of correlation, at least in the short term, in the 6 to 12 month period. Over a longer period of time, there probably is, but in the short term, there isn't. And in fact, the greater correlation is on the upside in the overall market. Their contribution is greater on the upside than their contribution negatively on the downside. So in 2022, I just looked at that and was like, that was really a macro driven. Of course, there was slowdown in the tech growth because growth was normalizing. They overhired. They got the benefit from the pull forward of the pandemic. So it's not like they weren't doing anything wrong, but there was macro drivers that drove almost every other sector.
Well, before we wrap this up, the biggest driver was never in the history of the markets had the Fed gone from 500 basis points in a year, pretty much 13 months or whatever. So they go from 0 to roughly 5, 5.5. They come down, whatever we are, 4, 4.5, 5.5, whatever. So call it 0 to 5 and down to 4 now, let's say, ballpark. I know give or take, depending on Fed funds.
Yeah.
The question I have for you is, do you think the market and the economy can, now that they've signaled they're going to sustain that or keep that at that level, can the market and the economy and housing and everything survive with that? Not traditionally high rates, but relative to recently high rates.
If we have productivity gains, we have growth if we have economic growth, productivity gains, and earnings growth that supports all that, then we could grow. Look at the 90s. We can grow in high interest rate environments with elevated inflation. And the other thing is when you make the 2022 comparison, consensus is not looking for, even if you expect inflation to tick up a bit this year, even if you expect interest rates to stay flat, no one's expecting a 500 basis point increase in interest rates.
No.
No one's expecting inflation to move 300-400 basis points, right? So I think a 2022 repeat is very unlikely. I think, again, it makes the case for the 90s, where growth can support productivity can support growth, which can support higher markets.
Yeah, and that's such a great point. I always not only learned, but reminded also from guests about rates were higher and inflation was higher back then.
Yeah.
And we still, that whole graph of the market over the last 100 years and every shitty thing is marked on it and the market still survives. It's still up and to the right. You mentioned earlier you took some time off years ago and traveled. I'm fascinated by where you went, your favorite, let's say, top 2 or 3 spots in the world. Anything interesting you...
That year was so awesome. I mean, I traveled domestically, but I also traveled internationally. I traveled to Morocco.
Okay.
So cool. And, parts of it were a little nerve-wracking. I was with a group, but...
I've been. I know some of it's, unfortunately,
But that was cool. I did Spain. Where else did I go? I went to Florence by myself. You know where else I went? I went to Nicaragua.
Never been.
I did that part of that on my own, and I went to Colombia completely on my own. A friend met me for the rest of Nicaragua. We learned to surf. I wasn't that good at it, but I had fun doing it, so that's all that matters.
Okay.
And then I went to Colombia totally solo. My parents were losing their mind. They were like, "What type of statement are you trying to make going to Colombia by yourself?"
Yeah, seriously.
But it's so different than, speaking of the 90s, I think people still have that drug cartel memory of Colombia from back then, and it's a completely different place. Granted, it was a handful of years that I went, a handful of years ago, but I had a blast, and I met this older couple from Florida, and I didn't know very much Spanish, or what do they speak there? Is it Portuguese?
No, Brazil is Portuguese. I don't know about Colombia. I think it's Spanish, but it's a different dialect, I think.
Different dialect, and so I didn't know very much, and so I was listening for any English I could hear. And I think everybody should travel by themselves to a foreign country at least once, because I feel like you learn a lot about yourself, and it brings you out of your shell.
Opens your mind.
It opens your mind.
Yeah.
You learn so much. And so, I don't know, that's my recommendation. My one tip for the show is everybody travel abroad by yourself once in your life.
My friend goes to Colombia for stem cells because he says it's the best and it's cheap, and he goes twice a year.
Oh, one of my girlfriends goes for plastic surgery.
Well, a lot of people do that, yeah. Yeah, I have a friend who went to Turkey. He's like, you should go to Turkey because he did his hair in Turkey. I'm like, you know what square footage I have to cover? It's going to cost me a fortune. But people do go Thailand, Turkey, South America for plastic surgery. Yeah, all sorts of nips and tucks, as the show says. We'll end on this. Your advice, I know, to your younger self. I know you're forever 31.
Yes.
But to your advice, what would you tell either viewers listening? Because obviously, and thank you so much for doing this. I'm sure there are, people, especially women, who are looking up and saying, "Shit, she knows a lot of stuff. You're very knowledgeable. You're presented very well," and they're probably like, "How do I get into this?" What advice either do you give them or you would give your younger self?
Maybe I would take it just back to the beginning of what we talked about early on. You could figure out anything, but also don't do it. You don't have to do it alone. Lean on the resources that you have. Don't feel too nervous or uncertain to reach out to others, because people, especially in this industry, love to share their knowledge. They love to connect with people that are curious and interested about what it is we do, how we think about the markets and all that stuff. I think you would agree with me, right? And
yeah.
So it's not a closed box. I think a lot of people look at finance as this exclusive club, and it's not. Once you get to know the folks in this industry, everybody welcomes you with open arms. You got to do your work.
Yeah.
But it's, don't be afraid to reach out to people is what my advice would be.
Awesome. Thank you for doing this. Thank you for your kindness. Thank you for being an inspiration, for being a great friend. Your TED Talk, How to Take Ownership of Your Career. Everyone should check that out. That was awesome. I appreciate you doing this, and hopefully we can do it again soon.
Yeah, I'd love that.